piggyback loan is basically a second mortgage that you take out simultaneously with a first mortgage that piggybacks on top of it behind it. That's why it's called a piggyback loan. This is something that we're starting to see more. We didn't see them for a really long time. 10 years ago, like they weren't super common. They were very, very common in like the early 2000s. So anybody who's heard of an 80-10-10 or an 80-15-5, et cetera, et cetera. Like basically what it is you would take out a first mortgage for 80% of the home purchase price. You take out a second mortgage for 10% of the home purchase price, and you put 10% down. That would be an 80-10-10. What this allows you to do is you actually avoid PMI because your first mortgage is only 80% of the purchase price of the home. So 20% down or more, you avoid PMI. And in place of PMI, you're taking out that second mortgage for 10% or 15% of the property value. The other thing that this allows you to do, specifically in Florida, is circumvent conventional underwriting guidelines that require full budget reviews of condominiums. There's a very kind of obscure guideline when you're taking out a loan on a condo that if you're putting less than a certain amount down, the condo association has to go through greater level of scrutiny by the investor. So by taking out one of these piggyback loans, you take a 75% first mortgage, a 15% second mortgage, and that allows you to totally avoid the condo's budget being looked at. Whereas if you were to put just 10% down, you would need to do a full review of the budget. They need to meet a certain percentage of reserves. And a lot of the condos, especially now in South Florida, are not meeting that higher level of scrutiny that's required. They don't meet the requirements for reserve budgeting. So by taking out this piggyback loan, you can totally avoid even looking at it and be eligible, get a property qualified that otherwise wouldn't qualify.